Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler with another episode of That Annuity Show. And we're missing Mark today. He had, I think, a commitment with somebody he worked for, so which we excused him for this time. Will, great to see you.
Good to be here, as always.
Good. Ramsey, nice to see you in warm Atlanta.
Yep, delighted.
You don't have the amount of snow I'm looking at out the window. I know that. So
you can count on that.
February's making up for the winter so far up in the Northeast. So
yeah, it really is. I guess this is winter. So hey, we've got a great returning guest. Ramsey, do you want to do the honors?
Absolutely. So we're delighted to be joined again by, Bruno Caron, if we pronounce it the American way, or Bruno Caron, if we pronounce it the correct way. So we're bilingual here, so we'll go both ways here. Delighted to have Bruno back. Since the last time Bruno was on, he published a book. It's called Lifetime Income to Retire with Strength. And it has a great tagline because there is a cost associated with living, which is something that is, one, very true, and two, is not widely enough appreciated. And of course, is the underpinning of everything we do. So Bruno has an amazing background. He's been an equity analyst. He now works at AM Best. So he basically manages the scorecard for many, if not most of the largest life insurance companies. So he's got great perspective on a number of different issues. And now he's really given this gift for the personal finance. So with that, Bruno, pass it over to you. Tell us a little bit about yourself, and then also maybe you can start out with telling us what inspired you to write this book.
Well, of course, and again, thank you for having me again. I mean, it's always a pleasure and an informative and fun conversation. So thanks again. And the book is a compilation of many years of thinking about annuities, writing about annuities, analyzing annuities from various angles, and just the simple fact, as you mentioned, that there is a cost associated with living. How do you tackle that? How do you account for that? How do you bring that into retirement? It's still an underpinning question. At the risk of repeating what you said, it's an absolute. It's an absolute. I don't even want to call it risk. It's a framework that we want to bring forward. So with that, came the book.
All right. Well, that's great. I'll just jump in, and I think you've done I like the book. Yeah, I think retirement books are not something that people normally pick up and read at the airport. And I think the challenge is, do you write it so thin that it's not useful? Do you write it so thick that nobody picks it up and it's a great, book on the bookshelf? I think if you've done a really good job just cutting to the core, who should read it and how should they read it? Should those people read it?
Oh, thank you, Paul. I certainly appreciate that. And who should read it? I mean, it's targeted for financial advisors. Who should read it? Kind of the broader audience is every financial professional. Should have some knowledge to read it through. Basic understanding of the reasonable the big asset classes. What's a balance sheet? What's an income statement? Those kind of things. Any financial professional should be able to pick it up and read it fairly easily.
So how do you get it, Bruno? Do they go right to your website, and how's it being distributed? Are people does it fly up else?
It's on Amazon. The ebook just got published, so both on Amazon. It's also available at Word's bookstore in Maplewood, New Jersey. So these are the places you can get the book.
Yeah, so I think you can read this with a number of different lenses, Ramsey. I'll be real curious since you've been a real a very big advocate for Spies and Ds. How did you? how did you read this? What caught your attention?
Well, first of all, like, Bruno and I have been talking about this for a while, so I was, waiting with great anticipation for it to come out. I think the main challenge that we often have in this space is really getting financial advisors to think even more holistically and about the role of these products. So I want to turn this into a question for Bruno. Like, what is it you think is missing right now in financial advice that your book sort of specifically helps address? Because presumably they're financial professionals. They're supposed to know all this stuff already. Right?
Yeah, absolutely.
So that's the controversial question. So tell me, what is it, why do you think that this is the missing link?
Well, it's really about looking at both the income statement and the balance sheet of every single individual. I was recently at the car dealership. We all know how fun those experiences are. And, I leased a car about 3 years ago. Now it's time to make some changes. But to make a long story short, I asked the salesman, who's a really cool guy, like much cooler than I am. Fun guy, very entertaining. So I asked him, okay, I trade my car, I get this new one. All right, that sounds really nice. How much does it cost? $500 per month. Okay, that sounds good. It's like, all right. So what's the underlying interest on that? Ooh, I don't know that. Ooh, how long do I pay $500 per month? Ooh, I don't know that. So in my actuarial mind, I was only looking for one particular assumption. I could figure out the rest with my Excel spreadsheet, but no. And I think that this really illustrates the fact that when we are in our working years, what we think about is earnings. How much can I afford? How much can I pay? What's going to be that cost? And earnings. And that's what drives the decision. I was also very curious on how long I would pay that, and how much would I need to cut a check today, which would be kind of more akin to a, kind of a balance sheet concept. I was very interested in those questions. But the simple fact that the car salesman was really driven by just earnings kind of illustrates how people think when they're in their working years. Mm-hmm. When you switch to retirement, it's the exact opposite. How much do you have for retirement? Oh, well, X, Y. I have, X amount of dollars. I have, that much 401ks. That's so many CDs, and it's account value. It's balance sheet. How much you have, and how does that translate into income? Well, we don't think about that. So my point is not to say, we really need to focus on the income statement, or we really need to focus on the balance sheet. It's balancing both. It's looking at both. It's looking at things from all of those perspectives. And I think that's the idea behind it. And to answer your question, Ramsey, what are people missing is that interaction between the two, for which for many financial professionals may sound like the obvious, but it seems like into retirement planning, we kind of overlook we focus on the balance sheet, but not on the income part of it.
Yeah, I think now I'll read this book because my biggest problem, Bruno, is how do I explain to people very simply how these products work? Will, you'd love it. I got a chat the other night from some guy who says, "I'm 72. I don't feel like my annuity is making enough money." Like, okay, Bruno, well, let me wind. How do I wind this one back and explain it's insurance, not investment? There are other reasons, which value are you concerned about, right? These are really complicated topics to kind of break apart into simple stories. And you've got a couple I want to poke on. Now, again, you guys are all relate to this. I think, okay, I know everything here. I'm no, and then read a book. I'm like, I didn't know that. You have some good examples of explaining mortality credits. Okay, decimation. No idea the source of that. Will, do you know where decimation comes from? The word?
No.
Bruno, help us and tell us how how this is used to explain mortality credits.
I'm glad you picked up on the 4 years of Latin I did in high school, which is very, very unusual for everyone. But in the history of Latin, decimation is a very morbid topic. But it was used in with the Roman Empire, basically as a punishment to some of the troops of soldiers who didn't act appropriately, and the punishment was to literally kill 1 out of 10 people from the army, and obviously that would motivate the rest of the army to perform well. So
yeah, sorry, Will, you missed those incentive targets. One of us gets killed.
Yeah, talk about incentivizing.
Yeah,
exactly.
It was 1 out of 10, irrespective of whether or not they were guilty of anything. So if somebody committed a wrong, and then 1 out of 10 took the hit. It didn't matter whether or not.
The regiment did something bad collectively. They didn't march quick enough. They didn't,
correct,
back people up right.
Exactly. So, and to go back to your question, the example of decimation was used to form mortality credits to look at mortality credits. So, from a financial perspective, you could have 100 of these particular soldiers putting all of their money into, not all of their money, but the same amount of money into a chest, and lock it up. No cost of storage, no interest, no underlying interest. And the idea was that people would just come back after the decimation, and whoever was left alive would just share that particular pool. And if it's 1 out of 10, you would expect that 90 out of the 100 would come back and kind of split all of the proceeds from the chest, but through a smaller portion of people. And the idea is that if you're dead, you don't need it. If you're alive, you get a little more. But it's a very morbid.
Well, you had another example that was similar, where you talked about, you did this exercise with kids.
The schools. I'm like, my gosh,
right? And
that give these kids nightmares. Tell us about the story. Yeah, how you did this at school.
Well, it was the AM Best work kids come into work day, which was a wonderful, a pretty wonderful event. But we all know what happened to that last year. And it, literally, the idea was to illustrate insurance, and we looked at every type of insurance: car insurance, home insurance, life insurance, and I came in with SPIAs. And the idea is to really go to the very fundamentals of risk pooling. And a whole bunch of people put their money in, and if someone needs it, they get it. So it's so we did that for car insurance, for home insurance, and for the for SPIAs. I think one of the I had two two kids who were pretending to be 70 years old, and we were basically saying, well, they both give the same pile of money, and as the insurance company, I was redistributing those funds as they were living. And the idea was that one dies earlier than the other, and the one who dies later continues to get some money. Now, the one who dies earlier screamed, "Well, that's my money! You're taking my money away!" So I thought that illustrated really well the concept of SPIAs. And that's really saying, well, yes, if you die early, if you calculate your investment return on your SPIA, it's going to be pretty bad. If you die late, you're actually going to be pretty good. And if you die around your life expectancy, you're going to break even. And you have to compare it with, fixed income type securities, which have the similar credit credit quality. And if you do that comparison, it makes sense. It's a fair deal. It's a good deal. And the idea is that if you live longer, you need more money. It's really that simple.
Okay, so my question for a follow-up is, given where interest rates are headed now, we've gotten a little bit of uptick in the last couple of weeks.
Oh.
Thank God.
That's generous, Paul.
Yeah, a little tick. Little uptick. Heart pumped up a little bit. Do you think, Bruno? And you have some great sort of sections in the back about what where we're headed. Do you think we're headed back to products that are more mortality based than driven value driven by interest rates?
Well, I think that's a really good question, and the answer would be, why not? It would make sense, right? Because those in the interest rate environment we live in, if we compare that to SPIAs, which are kind of the poster child for a lifetime income, but lifetime income encompasses many other solutions. But if we drill it back to SPIAs, there is this wide notion out there that you should not get SPIAs in the low interest rate environment because interest rates could go up. Well, the way I see it is that you need SPIAs more than ever when interest rates can go up, when interest rates are low. Because if you have some capital, the only way to generate income, if you're make it 0%, if you're in a 0% interest rate environment, you generate $0 of investment income with your capital. So you have to somewhat deplete it, or you can just not spend any money during retirement. That's another option. But for those who want to spend some money during retirement, you have to spend that capital for a certain amount of time that you don't know in advance. You just don't know in advance how much and how long you'll have to deplete that capital. And that's why this PIA comes in and says, well, give us your capital today, and regardless, we'll give you that check as long as you live. As long as it's actuarially fair, I think that's a really good it's an avenue to consider. So
there are a couple of things that intrigued me in the book. One was something we talked about the last time you were on, which was negative bequest, which is a term that I think is just a fantastic one, because it actually is rich with implications. And then the other one was predicting one's age. So let's start with negative bequest, and then I'd love to chat with age prediction, given the age you've achieved, which is something people don't sort of differentiate with, absolute life expectancy. So we'll start with negative bequest. Tell us about what that means and how that plays a role in planning.
Well, negative bequest is basically longevity risk. Basically, at the end of the day, right now, the big focus is, I have, as a retiree, I have a spending rate, and the more I spend, the more likely I'm going to run out of funds, and vice versa. The less I spend, the less likely I'm going to run out of funds. Now, that trade-off can be very uncomfortable and can result into negative bequest, which is longevity risk. But if you die earlier than expected, it just results in unnecessary curb spending. You could have spent much more money than you thought, but you had to plan for later. So what lifetime income does is that it increases that amount of income you can spend every year, every day during retirement, at the cost of bequest. So spending versus bequest is a better trade-off. It's a better framework than spending versus probability of ruin, because probability of ruin, what's that number, and how do you calculate that number? Is that number even relevant? And is it really 99%? Is it really 99.9%? And if that 0.1 or that 1% happens, that's catastrophic. Do you want to take that risk? So lifetime income is that instrument that really cuts between and allows you to have that shift, that trade-off to a spending rate versus expected bequest. And keep in mind, to your point, Ramsey, that expected bequest can be very high, can be very little, can be but as long as you have a target for that bequest, keep in mind it could be zero. I mean, that could be your target, but you definitely don't want to have negative bequest, because
Right.
that could be
so avoiding negative bequests is really, planning for something being zero or greater. That's really
exactly, and that's a question of personal preference. But that whole idea that, oh, if you die younger, you'll leave a whole bunch of capital, a lot of funds, a lot of money to your kids or charity, whatever it is. But if you die much later, you'll leave basically nothing. And if you die much later, you may be a burden to them or society or whoever. Yeah. So lifetime income kind of addresses that, and helps retirees calibrate that right amount.
Hey, Bruno, I mean, I think we're all advocates of exactly what you're saying, but it seems like there's just a lot of folks that either resist or aren't aware, or don't take advantage of lifetime income opportunities, whether that's a SPIA or whether that's an income rider or whatnot. How do you foresee, or how do you envision changing that dynamic? And is your book kind of a catalyst to get folks to think more broadly about it?
Well, the number one reason, the number one thing would be continuation of good podcasts like yours. I mean, definitely, that's the number one thing. So the more, and I'm somewhat joking, but somewhat not joking, awareness, education, and talking about those topics and bringing those forward, like you guys do. That's definitely one. That is, no one can argue that we need that. And then, in terms of regulation, I mean, some folks, and I know you've had some regulation experts on your show as well. That's a big focus. It's a big part of it. So all of these are definitely part of the solution. New products, perhaps. That could be another another avenue. Compensation mechanisms. That's also another issue. So all of these kind of need to be addressed, as an industry. And at the end of the day, as you pointed out, I think we're all for those particular type of vehicles. It's how we bring them forward, and how they surface in reality.
Yeah, just pulling the new product thread. It's interesting, connecting all sorts of conversations we've all had with different people. Tauntings, again, Bruno, learned something new. I didn't know the Armstrong Commission had made tauntings illegal. Ramsey, where was I? I didn't realize this. Now, I actually had a startup, and I want to, they're kind of working at this thing, but they've got a product that's kind of taunting like. What would have to happen for us to go to the New York, state, or the New York, the DFS, Will, Bruno, Ramsey, and say, look, I want to do a taunting. Here it is. I mean, is that it's something that's even feasible today to do something that radical?
Well, well, you can't say I didn't try. I tried, and it was not to pick on any regulator, but but I did try a different route. And what would it take? You have to have it's as a business, it's very, very tricky, because it's one of those businesses that doesn't require that much capital up front. So you would think it wouldn't be that complicated. But you don't need capital, you do need scale on day one. And that's the one of the important thing for bringing this product forward. you need scale. So you need to convince at least, some, at least one big brand name out there to get on board. So, well, I think that would be, one of the ways to bring in. The other key question is, well, is it an insurance product or is it an investment vehicle? So, which way to you legally structure it, and that's not my expertise. That's not my particular background, but I know that those questions are lingering and need to be addressed. So does it make sense for an asset manager to bring it forward or for an insurance company to bring it forward? I guess time will tell.
Yeah. Hey, Will, I want to create a blockchain taunting, okay, where you will put the currency, you will give me, I don't know, I'm going to butcher the name, 10 Dodge coins, right? That's the latest one, right? Everybody puts Dodge coins in, and at age 90, if whoever makes it, when this whole group makes it to 90, they get the payoff. Like, is that insurance? I don't know
if it's insurance. I think Bruno alluded to it. Is it insurance? I think that's a question that needs to be, or is it an investment? Is it some type of hybrid combination? But it's an intriguing question. I mean, I heard yesterday you're going to be able to buy Teslas with Bitcoin pretty soon. So why not some type of longevity vehicle where folks pool money? I mean, I think that this topic's come up a few times on this show, and it is one I think that folks are poking at, and I know Bruno has. So I don't know the answer to that, Paul. I think, but that's not a threshold question, but it's a question that, if it's an insurance product, there's a regulatory regime that's
right.
That introduces a challenge. But if it's an investment product, maybe the path is a little less complex, but
right.
I don't know. We could probably talk about that for a whole.
No, I know. What do you call that lockbox with the Roman soldiers, right, Bruno?
No, absolutely, and but at the end of the day, the idea is to make it fair, make it accessible, and right now, if you could. If you, one of the very key things about those particular vehicles are the fact that you could have direct mortality credit mechanism, but through other underlying asset allocation. Right now we talk about SPIAs and we can make all of those comparisons, but it's the SPIA right now is fairly limited to to fixed income underlying investments. Variable annuities come into to play as well. It's just structured in a different way. But if you want to get the pure mortality credit with the pure investments, underlying investments, that would be the avenue. The other advantage of those the tontines or the survival sharing of these worlds are the fact that the structure is there, the mechanism is there, but there's no guarantees associated to it. So the consumer can take a little more risk and have more volatility in its income, but you get a better expected payout, all else being equal. Oh, Ramsey, you're on mute.
Yeah, you're still on.
All right, that explains it. All right. I guess from my perspective, as I listen to it, to me, a lot of it is operational capacity. It is credibility, right? You mentioned scale. So, you need to be able to draw a lot of people into the pool. So you have to have the credibility to do that. You need to be able to decide who's owed what and cut the checks for like the next 50 years. Right. And so I sometimes think that maybe, whether it's insurance or investment isn't really as important as what entities have the capacity and the credibility to provide that service from now until some long time in the future. And that's why I've always sort of, we talked about this when Moshe Molesky was on, but like that's why I always favor insurance companies, because they seem to be most sort of set up for that sort of that paradigm. So I don't know, what are your thoughts on that?
Well, there's definitely that mentality in insurance companies of, long dated liabilities, and that entire that entire mindset, both through stock companies and mutuals. And so there's definitely that type of mentality. So that would make that would make perfect sense, and I would certainly agree with you.
So I just want to return to something we touched on a little bit earlier and weren't able to finish out, which is this idea of people understanding life expectancy. And I had a conversation with a gentleman the other day, and he said he went on the Social Security site and figured out that he was 68 and he was supposed to live till 82, and so 14 years left. And I said, well, that's the mean, right? And that's the mean for somebody that may have been younger. There's all sorts of reasons, like it doesn't actually reflect the distribution. Absolutely. And in general, and sort of his personal distribution, like what can we learn about that? That was a very important theme in your book. What can we learn about that, and then tie that into the importance of AIM and longevity protection?
Well, you said it exactly. That's exactly the key point, Ramsey. It's a distribution, and the mean, the average of that distribution will tell you something. And it's actually very telling for big institutions such as insurance companies and employers, governments, who deal with populations of people. And if there's a lot of people in a group, you can make those kind of calculations and get an idea of either how much it will cost to fund those future payments and so on. But as a person, if you take your example of that person who's 68 years old, that person may die within the next year, may die within its second year, from retirement, his third year, and you can go on to 40th year, 41st year. It could go on for a long time, and it's a random distribution. And if a lot of people will try to either guess or say that, oh, I'm gonna be that average. I'm gonna be above average. I'm gonna be below average. Well, by definition, half the people are half the people are gonna be above, and half the people are gonna be below. And there's a random element. There's a major random element into this. And at the end of the day, if you plan to live up to your life expectancy, you probably have a remote chance of getting it right. 4-5%, depending on which mortality table you pick, which means that you have a 95% chance of getting it wrong. So, and getting it wrong just may mean that you spend too much or you spend too little, and that's where lifetime income comes into play. It helps you kind of calibrate that whole risk. So.
Yeah, Bruno, I think you're absolutely right. I mean, I didn't know it was 5%, but that's why you would, insure yourself, because 95% of you don't really know. I was talking to someone who's in their 80s recently and said, oh, I made it to my life expectancy or whatever it was. And I said, yeah, now that you have, I don't know, I'm not an actuary, but the chances are that you probably have a few more years ahead of you, because you've passed some time where things might happen, from a health perspective. But people just don't know. And I think that's the unknown that we all try to solve for with some of the products that we talk about on the show.
Absolutely. Absolutely.
Yeah. And kind of continuing along that discussion, you also got sort of a thread of social goals, social welfare, I think. We've seen how stressed out people can be over the last 10 months when we're living in the great unknown. Maybe you could just talk a little bit more about like the habits in psychology that help, right? One problem is, hey, I run out of money, I spend too little. The other is we're all better off collectively if everybody has some peace of mind. And I think you said most workers have been employed throughout their lives, periodically receiving a paycheck. This creates habits. Some experts believe that recreating this financial environment through retirement is desirable, as habits can be hard to change. I think of your example of the car. I mean, what does that do collectively if more people had this kind of assurance, in later years?
You alluded to it. You answer your own question, Paul. Stress. You relieve stress. I mean, that's one of that's one of the very easy way to do it is to get that either that lifetime income, that guarantee that's out there that will just that'll just be there as long as you live. I mean, bills keep on coming while you're alive. It's that simple. And collectively, I think it becomes a major it could become a major societal issue. I don't know how many times, I don't know if you count them, but the number of people who quote that 10,000 people turning 65 years old every day. I don't know how many people quote it on your show, but here's another one. Population is aging. It's that simple. People are not only living longer or retiring even earlier, so that retirement lifespan is much wider than it used to be. Throw on that more people in it, it could put pressure on the system, and that's basically and how society will react to it is a big unknown. So if you could alleviate some of those pressures with lifetime income, and saying that some of the people, if you die earlier, you will lose from an investment perspective, but you will gain if you die later. Just like if you don't have a car accident, you will lose on your car insurance. I mean, basically, you don't have you don't have any claims, and you paid a premium. Your return on investment is pretty bad. It's negative 100%. But if you do have a car accident, you will benefit from it. Why will you benefit from it? And well, because you insure yourself, and and that payout comes out at a very, very convenient time when you need it. A lot of people I know will earn more in a year than the price of the car they're driving. So everyone insures themselves against car insurance, but why not against longevity?
Such a great point. And that's just it. Like your car insurance, you get the car insurance so you can actually get in your car and have the peace of mind to drive to work and know that you're not going to lose $20, $30, $40, $50,000 if you get in an accident. So it gives you permission to do so many other things. The ROI is in the things that it gives you permission to do. And that's, that's the thing that you highlight so well, in the book. So yeah. Thank you for that.
Well, listen, we're close to the end of the time. I don't know, Ramsey, Will, other questions for Bruno?
No, the perspective, Bruno, is very, very helpful. I mean, not to use an analogy, but you're really driving home the point that, if you insure your car and you insure your house, you should really insure yourself for longevity. And the other point that you made that I don't think folks talk about much is the societal pressure. For personal stress is one thing, but the pressure that thousands and thousands of people who don't have income in retirement puts on society is immense as well. So there's so many dimensions to this conversation, and I think it's a conversation we're going to continue to have on this show. And your perspective is extremely valuable. And I think this is a topic that we kind of keep having to beat the drum a bit on this.
Yeah, and I'll just say, focusing on the the AIM structure and the interplay between assets and income is just super important. It's just like when people focus on stock returns being positive or negative. Well, volatility is actually where a lot of the action is and a lot of what's going on, right? And so in this instance, you're really focused on the interaction, and you can say, okay, if I'm a financial advisor, it's all about stocks and bonds, so it's balance sheet. If I'm an insurance agent, I'm all focusing all on the income side. But the right answer really is in that interaction. And to your point, like checking on it on a periodic basis to make sure that you're adjusting dynamically. So it's a great life lesson. Thank you.
Yeah. So, hey, Bruno, thank you so much for doing this. And the title of the book is Lifetime Income to Retire with Strength. Find it, as you said, on Amazon. Where else?
Ward's Bookstore in Maplewood, New Jersey. But Amazon is has it on the paper version as well as in Kindle format. So they're both there.
Excellent. All right. Hey, well, listen, thanks so much. Thanks everybody for listening to our show. Please give us comments, give us feedback, tell your friends to listen to it. And Bruno, we'll definitely have you back again. Thanks for spending time today with us.
Well, thanks to you. I certainly appreciate it. And good luck in continuing the wonderful message. So thank you.
Hey, thanks.
Thank you.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.